Hi everyone. So today I'm creating a new video, basically giving you an summary of all the things that I'll be teaching in both beginners, intermediate, and future options course, so that you can take a informed decision on whether or not you want to pursue the course and pay for the fees. This just will be a brief summary of all the things that I'll be teaching. So let's continue the video. So this is the starting of the video, and this is the disclaimer. So this video course is created solely for educational and awareness purposes. I am not yet SEBI registered, so I'll get my SEBI registration. I am pursuing multiple courses and certifications to get my SEBI registration. So it will take around 1 to 2 years because I'm from a non-finance background. So I have to pursue a lot of courses before I become SEBI registered and I can officially give advice on buying and selling. So till then, this is just for solely and education and awareness purposes. And if you plan to use any of the strategies, please use your own discretion. Understand that there are risks associated with stock market. Okay. First, let's understand the beginner's course. Now, understanding the beginner's course, you need to understand the building blocks of the stock market. What exactly is stock market, and what exactly are the things that are within the stock market. So here, first, what I will do is in the course, I'll be creating a private limited company, and then we'll discuss the valuation and profits of the company, and then we IPO the fake company, make it public limited company, and then list it on stock market. I'll not be describing the IPO process in detail, but brief idea just to get you acquainted with the process. And then once we list the company in the stock market, then you'll understand like how companies actually get listed. So you can understand about basically the main thing is about valuation of the companies. And then we discuss Nifty 50. And then first, before understanding the entire stock market and Nifty 50, you need to understand the building blocks. The building blocks are companies. Okay. So, for example, if I have one hospital, I'm a hospital owner. If I have 10 hospitals, then I have a private limited company. And if I have 100 hospitals, then I have a public listed company or a stock market listed company, or I can apply to be a stock market listed company. So, to understand the stock market, first you need to understand the valuation and the process behind a company becoming from a private limited company to a public limited company. So this is like the foundation blocks. So see this beautiful building that has been created using small Lego bricks. Okay, this looks beautiful. And then if you see, all of this is done using Lego bricks. These are kids' toys, and then this is the building block. Okay, so you create a large structure, but the fundamental essence lies within the building block. So to understand the stock market, first you need to understand how one company works, and then you can extrapolate it to 100 companies so that you can understand the valuations, the pricing, and everything. So the next discussion will be on how Nifty 50 works. What exactly is Nifty 50? What are its constituents? And how exactly does Nifty 50 work? And then I'll introduce you to the concept of index funds. Why index funds? Why not mutual funds? I'll be covering mutual funds in the second half of the course. So first half is only introducing you to index funds. Index funds have something called less expense ratio than mutual funds. We'll understand a little bit once you understand the mutual funds thing. So and then I'll introduce you to debt market. Debt market is a separate entity from stock market. It's a completely different entity. It's 10 times bigger than the stock market, but rarely used by retail investors. Retail investors are you and me. So then I introduce you to future and options. I'll not be discussing a great lot of detail on future and options. Mainly, we'll be using only one component of future and options, and then we use it only for insurance. We do not do any trading or anything. It's only for insurance. Its purpose is insurance for your entire portfolio. I'll help you in understanding how to create, how to place the order, and how to do the. How we have to keep repeating this every month so that your portfolio is protected 365 days a year. In case a crash happens, you'll not be tensed. You'll make some money in the future and options. Basically, this is to compensate for the stock market crashes. Okay. And then this is beginner friendly. So I'm keeping all the financial jargon to a minimum. So this is beginner friendly. And I will not be discussing great detail all the financial concepts so that you won't be bombarded with financial stuff. So understanding the entire strategy will take around 2 hours because you are beginners, but using the strategy will take less than 2 minutes. Okay, once it started, then it becomes very easy. Once you get the flow, it's very easy to implement the strategy. And finally, I'll be talking about gold, not the gold that you see in the markets. There is a separate gold entity in the stock market, and then we'll be using that also a little bit in hedge. Right now, it's overvalued. Anyway, I'll let you know in the course. So you can execute the strategy even with an understanding all of the concept that I explained. You can execute it, but I prefer that people understand the concept and the fundamentals before you execute it. So last hours, I think it will take 2 hours, maybe a little bit more, will be on understanding mutual funds, the mechanics of mutual funds, what are the various charges that you pay for mutual funds, and how that charges are detected from mutual funds. And then I'll be talking about ULIPs. ULIPs are unit linked insurance plans. So they're basically sold highest to the doctors. So they say that there is insurance, and then there is you'll get money back. It's like life insurance, but you'll get your money back and you'll get tax reductions, everything. So my purpose is not to discourage mutual funds or ULIPs. Understand what you're getting into. Understand the mechanics. Understand the how they work and how the charges are taken and how they are charged exactly, so that you can get a better understanding of the mutual funds or ULIP that you own. Okay, after finishing the part one of the course, which includes the till the strategy, I'll take a poll to see if you are interested in continuing on the same day or will continue on the next day. Because this will be, I want to experiment. I don't know. I feel like we can complete the entire thing in one day. But if people feel exhausted, then we'll take another Sunday. So the course will be for 2 days. The price is 6,000. I'll be continuing for 2 days or 3 days if required. So only after few branches come out only I'll understand. Few batches come out only I'll understand if we can conclude this entire course in one day, 2 days, or 4 days. All of them will be on Sundays, and all of them will be on online Zoom classes, so that I'll get a better understanding. According to me, we can clear it off in one day, but maybe the financial knowledge will be too much. So maybe 2 days, maybe 3 days. It doesn't. You won't. I won't charge anything extra. It will be the same thing. We can continue it. So I'll be adjusting finally. Once I get the proper feel of how many hours this needs to be properly taught, then maybe I'll extend it to 4 days, maybe if it becomes too much. So I already have mutual funds. Should I take the course or why take the course? If you already have mutual funds and are happy with the returns, I will show you how to compare your mutual funds to a benchmark. So this will be taught. So once you know what a benchmark is and what are the returns in the benchmark, then you can understand if your mutual funds is actually really making money for the expense ratio that they are taking from you. So, and then again, okay, let's forget about the benchmark and everything. So I will also be using future and options and also debt funds. Okay. So what you'll be doing is you will be putting some money. Okay. For example, you're doing SIP of 10,000 or 20,000 or 30,000. Some amount will divert to debt funds also, and again little bit amount will be putting in insurance. Okay, even if you have mutual funds, you can continue your SIPs, you can continue your premium. It can be monthly, it can be yearly, but some amount will divert to debt funds also. Why debt funds and why future and options? So I'll tell you. So basically stock market runs in cycles. Every financial instrument, gold, even real estate runs in cycles. Everything runs in cycles here. So for the stock market, it has named cycles. They are called bull market, consolidation, and bear market. So bull market is expansion phase. All of the stocks that you buy, irrespective of the fundamentals, all of them, most of them will rise. And then there is something called consolidation market or sideways market. So Nifty will be bouncing between 2 points. You'll not be seeing much returns here. And then there is something called bear market. In bear market, what happens? All of the stocks will be in loss. All of the mutual funds will be in loss, and the returns are very less here. And then again, bull market starts. So basically, what happens is after the bear market ends, the smart money is mutual funds and professional investors. They keep accumulating, and then they will create a new bull market. Okay, so stock market cycle runs like this: bull market, consolidation, bear market, and then there is fear here mostly. Usually, after a bear market, people mostly exit. We can see actual SIP outflows will increase usually in bear markets. And then once the bull market starts, more and more SIPs come in, and then there is consolidation. It keeps repeating over many years. So this is Nifty 50. So this is the Nifty 50 chart. This x-axis shows the years, okay, and the y-axis shows the price of Nifty 50. You can see that the entire trend will be up, but if you zoom in and see that there is a crash here, okay, and there is a little small bear market here, okay, and then once we go here, you can see that there are bear markets here also, okay. Recently we had 6 months bear market, so all of the stocks were falling, and then there is a rise, okay. If you want so here I'll be drawing lines so that you can understand. So I'll be using arrows to show bull market and consolidation market. So here in 2016 to 2020, we had a good bull market. And then there was a crash in COVID, huge crash, market corrected a lot. And then again, we had a bull market. Okay. And then we had a small bear, but here we can say it's a consolidation market. Basically, what happened? First, there was a bear market, and then Nifty was bouncing between 2 points. So for 2 to 3 years, this went on. Okay. So people who invested at the top point, they did not make money till 2023 ending. Okay, that was the point it crossed. So we cannot guess where we'll invest. So this was the consolidation market. Then what happened? Again, if you see, there's a bull market again after the consolidation. Okay, and then after that we had a small. Recently we had a bear market for 6 months. Right now we are in sort of a bullish consolidation. It is a bull market yet. See, this is a bear market. That 6 months we are in loss. Mutual funds are also were not giving much returns because that's what you need to understand. They are all cycles. And then right now we are in sort of a small consolidation. And if we cross the 26,000 mark, if Nifty breaks that mark, then we'll see a new bull market. Or if it doesn't cross, then we'll see a bear market or a crash. Anything can happen. We cannot predict stuff. Okay? So these are all the bear market. This was a crash in COVID-19, 2020. And then there was this small bear market here. There was bear market, bear market, bear market. So these are the times where people, SIPs reduce here. SIP means systematic investment into the mutual fund, systematic investment plan. So what happens is usually in bear market, people don't see good returns, and that's when they try to exit the market. But what you need to understand is after every bear market, there is a big, huge bull market. So right now we are in sort of here consolidation phase. If this line is broken, then we will see a new bull market. Okay, so this is consolidation. Okay, from 2022 to 2024, roughly 2022 to 2023. And then there is a bull market. Right now we are in this consolidation. If this line is broken, then we can see a good bull market in 2026 and 2027. Or if it's not broken, then we can see a bear market or a crash. We cannot guess things. That's the thing. So these are all the Nifty crashes that happened to Nifty. There was 1992 Harshad Mehta scam. Then 2004 there was a crash, and then 2008 was a financial crisis. Multiple crashes were there. 2022, 2020 was the latest one, COVID crash. Market corrected by about 40%. So now we have divided into bull market, bear market, and consolidation market, right? So debt funds, you can use two ways. One is for emergency money. For example, you have some emergency, but stock market is in loss. Now two things will happen. If you exit money here, you will be losing, first of all, money in the stock market. And second thing, you are exiting before the bull market. So double loss is there. So stock market doesn't always rise. This is the thing that you need to understand. There are multiple factors here. There are geopolitical, financial, macro markets. There are multiple things that govern the stock market. So it will not always rise. So for this, I have created a three-pronged approach. Here, you can continue your mutual funds, you can continue your SIP, or you can take index funds, which I will teach you. So here, the debt funds will make money in a consolidation market. So debt funds are independent from stock market and a huge market compared to stock market. Actually, if you see, I think if for example stock market entire money invested is 1 lakh, the money that will be invested in that debt market will be around 10 lakhs or 50 lakhs, something like that. That's a huge market, and mostly government invests in debt markets. But anyway, you need not know everything. So what you need to understand is during consolidation markets, debt funds make money. If there is a crash, our future and options will kick in the strategy that I'll teach you, and that will make money in the crash. Sometimes in bear market, depends on a lot of factors, but personally forget this. It may make, so we are not planning, we are not using future and options for bear market. We are planning future and options for crashes. Okay, that some amount of money will be there, at least some amount. Okay, and index funds or your mutual funds, if you have, they will work in bull market. So we have created a strategy which works in bull market, crashes, and consolidation. Okay, so we have covered all the three. So bear markets here, the future and options may get triggered, but I'm not expecting it. And if there is a crash, then our future and options will click in. In the consolidation market, our debt funds will make money. And once the market goes up, our index funds or mutual funds will make money. So now we have a three-pronged approach to the stock market. Index funds will work in bull market, debt funds will work in consolidation market, and future and options are mostly in crashes. So that your money will be making money while you're sleeping. So the money compounds on itself and you make money while you're sleeping. Okay, that's the ending of the beginner's course. Okay, now if you are happy with the beginner's course, you can buy my intermediate course, which